Hello, everyone, and welcome to Eagle Academy. I'm Tom, and today we're going to be going over portfolio management. So what is portfolio management? Well, it's really a plethora of decisions about investments that are going to help balance your risk, obviously, against some performance metrics, and then also matching your investments to your goals, your kind of financial goals, whether on the short term or long term, and that can also decide the type of portfolio that you'll be looking to have. And then also comprehending the weaknesses, the strengths, the threats, and opportunities while choosing the different types of opportunities and equities that you'll be able to invest in. And really the importance of portfolio management and kind of strong portfolio management is being able to build a selection of those investments that'll meet those financial goals, but also provide different levels of strategies depending on whether you want to be more passive, more active, again, whether it's going to be more short-term or long-term. But the key within all of this is that doing so will be able to reduce your risk while at the same time still beating the market. A lot of it is going to have to do with minimizing your max drawdown and making sure that you're getting into the most amount of profitable trades as possible, obviously, but at the same time, things do happen in the market. There is a lot of systemic risk, which is called market risk, and that's going to have a weight on your portfolio. So effective portfolio management is going to be able to reduce those risks, ultimately generating more significant returns. And so diving into some of these different types of portfolios, you obviously have the more active portfolio that's going to be buying and selling assets more frequently, with the goal to usually have a higher return. So that's where people will try to be a little more active. And the benefits of that is obviously leading to outperformance of some specific indices. However, this sometimes will require the help of a professional investment manager just to be as active as possible, or for someone that has a large amount of capital, this can be easier just to hand it off to different portfolio managers. But there are different types. There will be more passive ones, even within kind of mutual funds or ETFs, and then there will be more active ones as well. So that's kind of one of the main aspects of an active portfolio and why you would choose an active portfolio. Obviously, the shortcomings is that it's going to require more time and resources and energy on your part if you're going to be buying and selling these more actively, these securities more actively, and then trying to beat that market, buying and selling them more frequently. Some of these assets will entail more market risk, especially since more active investing is likely going to be investments on a much shorter term. Therefore, you can be susceptible to some large swings and market risk. So that's one of the key shortcomings there. But again, one of the reasons why some of the portfolio management we're going to talk about in a bit is so critical. Passive portfolio really is, within its name, very passive. It's using similar kind of weighting and stock selection that many indexes use. So you see sometimes a lot of passive portfolios are just a replica or a variation of some large indices and have very similar weighting to it. You're not necessarily going out and trying to beat the market as much. It's more kind of a less actively managed portfolio that's going to be able to generate consistent returns and more balanced returns that are going to follow likely a specific market or index that you're trying to replicate. A lot of the benefits there is it's going to lower your risk. It's going to use fewer resources, fewer time. It's also going to include lower management fees if you do go with a mutual fund or a more kind of investment group or portfolio manager that you'll outsource. But even for your own time, passive will usually be lower risk, lower resource, kind of lower time, which is great for different types of portfolios as well. If you have a very risk adverse portfolio, kind of as an alternative savings account, if you will, those types of portfolios or investment goals, if you will, are going to be more suitable for these passive portfolios and passive kind of assets. Obviously, the shortcoming to that is going to be the chances of outperforming the market is far more limited. So in terms of effective risk management, what are some of the do's and don'ts? Setting a stop loss at certain technical or fundamental levels is going to be one of the easiest ways to have effective risk management. That increases your risk reward and that is going to be the key to also minimizing your max drawdown. On the same kind of level, one of the don'ts is going to be putting more than 5% of your portfolio into a single asset if it is high risk. If it's very high risk, usually no more than 3%. And a lot of traders actually, especially if you have a smaller portfolio, sometimes that can vary. But for much larger portfolios, though, the most common rule that you can find in a lot of research is actually the 1% rule. So taking that even lower. For definitely more active investing, we would recommend probably to stay more on the lower side, as kind of some of the don'ts going above 3%, even for a lower risk investment. With the nature of a more active portfolio and actively selling and buying securities and equities, it will mean that that market risk is even more present. So the 1 to 3% there makes more sense. For passive portfolio, though, 5 to 10% can be more justified. But either way, even getting close to 10% reduces your ability to actually diversify as well your assets, because you're putting too much into one basket. And so that's one of the big don'ts. And so pair a smart allocation of your assets, 3 to 5%, with strong stop losses. Either trading stop losses or hard stop losses can really increase your risk reward ratio. Now, sticking to one type of portfolio at a time, either passive or active, will also help with this. And so that's going to be one of the key there. Because if you're trying to do passive and active at the same time in one portfolio, it's not going to really work. You'll have different strategies and different ways to offset some other investments, but it'll be difficult to kind of manage both in one portfolio. So choosing either kind of passive or active definitely helps. And then either passive or price target limit sells is also another one of the do's. And so we tend, especially on more active portfolio or within more active portfolios, tend to kind of hold on sometimes too long to certain trades. And being able to have a price target limit sell will make sure that you get out of the trade with your profit secured, and taking profits off the table is always a good decision, and will avoid any kind of maybe longer term losses, and also the psychological effect of the kind of more active trading. Having that price target limit sell will definitely help maximize those gains. Again, using price target limit sells and stop losses as well help to better understand your risk reward ratio, helps to better maximize that return, but also minimize the drawdowns, and also helps with that allocation. You know exactly what you're getting yourself into. You know exactly, based off your allocation, what that max drawdown on your total portfolio is going to be, and then you also know at the end of that what comes out of it from the other side. Now, don't, again, similar to sticking to one type of portfolio as the do's, don't try to use multiple strategies within a portfolio, especially if you're trying to be more passive. That could just really offset everything that you're trying to do, and usually is not recommended, just because of the nature of using all these different types of strategies means that you're going to have different allocations, means that different stop loss price target strategies, whether active or more passive, can all actually won't counterbalance each other as well as some people might imagine, and will create actually more drawdown risk and market risk than if you were just to stick to one strategy, kind of one set of rules for one specific portfolio. Obviously, you can have multiple portfolios that are going to leverage and use different types of strategies, more active, more passive, and that is definitely recommended. Obviously, not using stop losses, trading stop losses, or price target limit sells. Again, just makes you more susceptible to large market swings or market risk, which is the whole point of portfolio management, is to kind of reduce a lot of that market risk swings and max drawdowns. So I talked a lot about kind of risk reward. So to optimize your risk reward, here are some things you can kind of make sure to do. Obviously, adjusting trade size in relation to capital available is going to be a big one, and that again will help you understand what the potential risk to your portfolio will be. When you start putting that into perspective, it also makes it much easier to look at a trade and see if that's actually something you want to get into or not. Using the stop losses and limit orders to maximize that risk reward profile of a trade, again, will also make sure that you understand the type of trade and the outcomes that you're trying to, or you're going to get into, but it also basically guarantees these outcomes even to the downside. You're not going to be trading around the market risk and volatility. You've essentially got a channel between the stop loss and a potential price target limit sell that you want to trade in, and that you want your trade to kind of be within these metrics and constraints. So constraining these trades is actually a good thing, and will help maximize your risk reward profile. And then obviously implementing only a minimum of 1 to 2 risk reward ratio is usually what will be recommended for a stronger trade. Setting a decent risk reward is important because once you know where obviously your stop loss and take profit will be placed, you can consider the risk reward for that position. And a 1 to 2 as a general rule is kind of what successful traders will look to have as a minimum. Anything under that just isn't worth your capital allocation, and that's just based off the fact that you are risking way more than what you potentially gain. A 1-to-1 potentially, but anything less than a 1-to-1 is just not worth it in any sense. And again, that's where setting stop losses based off some technical or fundamental levels, and then a price target limit sell based off the same thing, can really show you on a trade actually where that ratio is. And if on these technical and fundamental losses, your stop loss that you're comfortable with having ends up actually being much further away than the where your profit take will be, you're actually then exposing yourself to much more downside risk, and closing kind of within that range of downside. And so it's just not a favorable trade to take. Whereas maybe before analyzing that, you would have taken that trade. In this case, now you won't take that trade. And so that's where it's important, even if you're not, strictly abiding to these stop losses and price target limit sales, which can always change. And that's where trading stop loss can also help. But being aware of that risk reward ratio and what you're seeing there can be really impactful. And so to kind of highlight this even further, another reason why a lot of these risk reward ratios you want to be above 1 to 2 is because if we look at the strike kind of rate win rate of these of any kind of general trade, you see that they're just not profitable anything below that at all. And so 1 to 2, is really the bare minimum that you need. Even at a 20% win rate, a 3-to-1 reward to risk ratio is still not going to be profitable. It only breaks even at 4-to-1. So again, showing you the types of risk you need for outperformance over a longer period of time with some of these win rates. For more active portfolios, kind of a 40-50% win rate ends up being more what realistically happens. And so again, a 1 to 2 risk reward ratio, in this case on the graph, a 2-to-1 reward to risk ratio is really the minimum you can do for a trade that is kind of attractive for your portfolio. For more passive portfolios, especially for the longer term, above 50% and above 60% win rates are typically what you'll see, if not higher in a lot of cases. And so that's where a 2-to-1 reward to risk ratio is definitely a bare minimum as usual, but is a much more probable kind of rate of success than if you were to be on an active portfolio where 30, 40, 50% is much more kind of in the cards, and why a lot of these more active traders won't choose anything below 2-to-1 or even sometimes 3-to-1. So just to kind of recap all of that, obviously the importance of portfolio management is to help you achieve your long-term goals, but not only that, there are kind of these two key types of portfolios they must tailor your risk management to. And so what we'll typically see is active portfolios like what we analyze with the risk reward are going to have or going to desire much higher risk reward ratio. whereas passive based off the win rates are not going to require as high of a risk reward. Then obviously optimizing that risk reward for any trade can, over the long run, create those more significant returns. Now, thank you for listening. I hope you guys learned something, and make sure to join Ego Investors, link in the description.